So, how does a sleepy, 63-year-old garlic bread and salad dressing company just suddenly find $400 million in cold, hard cash to buy a viral, TikTok famous Japanese barbecue sauce?
Right, it sounds like a joke.
It really does.
Yeah.
But that is exactly the question we are answering today as we welcome you to Talk Tickers. We're ripping apart the Q2 2026 earnings call for the Marzetti Company, ticker symbol MZTI.
MZTI, yeah.
And for this deep dive, our mission is to basically strip away all the corporate jargon, right? We want to give you the headline numbers, the actual real story behind those numbers, what management is forecasting, and most importantly, an actionable bottom line for your portfolio.
Exactly, because when you think of Marzetti, you normally picture that bottle of slaw dressing sitting in the back of your fridge.
Yeah, or that frozen garlic toast you just sort of throw in the oven on pasta night.
Right, it feels like this really slow-moving, heavily insulated consumer staple play. You buy it for the yield and you completely forget about it.
But, is that all it is? Are we just looking at a boring salad dressing company today?
Oh, well, no. Look, it's the ultimate defensive stock, sure. But even defensive stocks have to, justify their valuations in this crazy, hyper-competitive retail landscape.
Okay, fair.
So what you see on the surface is this legacy dividend stalwart. But what's actually happening underneath is it's this incredibly aggressive, highly calculated strategic pivot.
A pivot to what, exactly?
To capture a completely new demographic. They just dropped $400 million in cash on this massive Gen Z-friendly growth engine. So, this old dog definitely has new tricks.
Oh, wow. Okay, so we're basically looking at a legacy cash machine trying to strap a rocket engine to its back.
That is exactly what they're doing.
Right. So to understand if the chassis can even handle that kind of acceleration, I think we need to look at the financial foundation first. Let's get into the headline numbers from the second quarter.
Yeah, let's look at expectations versus reality here.
Right. So starting right at the top line, Marzetti reported consolidated net sales of $518 million for Q2 of fiscal 2026, which, represents an overall increase of 1.7% compared to the exact same quarter last year.
Yeah, and look, $518 million in a single quarter for a company operating in these really mature, heavily saturated grocery categories.
Right. The dressing aisle is packed.
Oh, it's totally packed. So that number is a massive testament to their baseline stability. But a 1.7% top-line growth figure doesn't exactly scream hyper-growth.
Yeah.
No.
Honestly, 1.7% looks like a business that is barely pacing inflation.
It does. But the top line is really the appetizer here. The bottom line is where the actual operational leverage of this company is exposed.
Okay, let's hear it.
So their diluted earnings per share, or EPS, it surged by nearly 21%.
Wait, 21%?
Yeah, it went up 37 cents to hit $2.15 per share.
Wow, okay, so a 21% jump in EPS on only a 1.7% revenue increase. That's a massive dislocation.
It's huge.
Which tells you right away, this isn't a story about selling drastically more units, right? It's a story about squeezing way more profit out of the units they're already selling.
Exactly. And you see the exact mechanism of that profit extraction right in their margin profile.
Right.
So Chief Financial Officer Tom Pigott reported that gross margins expanded by 40 basis points during the quarter.
Okay, let's pause there for a second. For the listener, what does 40 basis points actually mean in plain English?
Sure. So 40 basis points, it just means 0.4%.
Got it.
And look, in the high volume, low margin world of food manufacturing, expanding your margins by 0.4% across $500 million in sales is fiercely difficult.
It sounds like it.
Yeah, it requires structural efficiencies, not just, a lucky quarter of sales. It requires a ruthless focus on input costs and operational waste.
Because labor costs and freight are still heavily elevated everywhere else.
Right. Exactly. So when you expand margins in that kind of environment, it means your internal supply chain is highly optimized. And that margin expansion directly drove a Q2 record for them, $137 million in gross profit.
$137 million. Wow.
Yeah, they are simply keeping more of every single dollar that comes through the door.
And I'm guessing when you generate that kind of gross profit, you have a lot of optionality with what you do with it.
A tremendous amount of optionality. Which brings us to, how they are rewarding the shareholders who are holding the stock right now.
Right. The shareholder returns, because those were undeniably robust for Q2.
Very robust. They executed $20.1 million in stock buybacks.
Nice.
But the absolute crown jewel of this earnings call, and Arguably, the whole reason you hold this stock over the long term is the dividend.
Oh, yeah. The dividend is legendary. They paid out a $1 per share quarterly cash dividend, which represents a 5% increase from the prior year.
Yeah, and the 5% increase is important, but the historical context is what really makes it a staggering data point.
I know what you're going to say.
This quarter marked Marzetti's 63rd consecutive year of regular cash dividend increases.
63 consecutive years. I mean, let that sink in. They have been raising their dividend every single year since 1963.
It's wild.
The discipline required to maintain that through the inflationary spikes of the 1970s, right? The dot-com bust, the 2008 financial crisis, a global pandemic, it's almost unfathomable.
It really is. It transforms the stock from just a regular equity holding into a compounding income fortress for a retail investor.
So it's like having an ultra-reliable, albeit maybe kind of slow, vintage car. Like, it's going to get you there safely every time.
That's a great analogy. It forces management to act with a level of financial conservatism that you just rarely see today.
Right.
Because when your board of directors is fiercely protective of a 63-year streak, you literally cannot take reckless gambles. Every acquisition, every capital expenditure is viewed through the lens of, does this protect the cash payout?
But doesn't that conservatism breed its own kind of danger? Well, I mean, if you focus entirely on protecting the dividend, don't you risk starving the core business of the innovation it needs? Like, consumer tastes change fast.
Oh, absolutely.
Yeah.
And that tension is exactly what makes that 1.7% top-line revenue growth figure so pivotal.
Yeah, because you look at 1.7% and you have to ask, is the engine sputtering? Like, is the legacy business slowly exhausting itself just to maintain this payout? Or is this just cruising speed while they retool the machinery?
Right, because 1.7% growth on the top line is dangerously close to stagnation. So to answer your question about whether the engine is sputtering, we have to look under the hood.
Let's do it.
We have to look at how they actually made that $518 million.
Mm-hmm.
Which brings us to the story behind the numbers.
Okay, so the underlying volume metrics, they tell a very clear story about consumer behavior here.
Yeah, they do. So organic volume, meaning the actual physical tonnage of salad dressing, dips, frozen bread moving out of the distribution centers, it actually declined.
Oh, wait, it declined?
Yeah, it was down by 1.3%.
So consumers technically put fewer Marzetti items into their physical shopping carts this quarter than they did a year ago.
Exactly. Yet revenue still went up.
So we are seeing the classic deployment of pricing power.
You got it. They completely offset a 1.3% drop in physical volume with a 1.4% boost purely from raising prices on the shelf.
So they just charge more for less stuff.
Yeah, and this is the ultimate stress test for a legacy brand's equity, right? Price elasticity is basically the gravitational pull of the whole consumer packaged goods industry.
Meaning, if you raise the price too much, people just buy the generic store brand.
Right. In theory, if you raise the price of a jar of slaw dressing, some consumers will just abandon your brand.
Yep.
But Marzetti raised their prices, and sure, they lost a tiny fraction of volume, that 1.3%. But the vast majority of consumers just absorbed the price hike. They kept buying.
Wow. So the revenue gain from the higher prices completely outstripped the revenue loss from the slightly lower volume.
Exactly. It proves that their core customer is remarkably sticky.
But wait, that stickiness isn't uniform across their entire business, right? Because Marzetti effectively runs two parallel companies under one roof.
Yes, they do. They have the retail grocery business, and then they have the food service commercial business.
So looking at retail first, net sales actually dipped 1.1%. And management attributed this to a couple of highly specific headwinds.
Right. First, they were lapping an absolute monster of a quarter from the prior year, where retail saw 6.3% growth.
And for you guys listening, lapping a tough comparable quarter is just standard corporate reality. If you have an abnormally strong season, the math the following year is always going to look a little depressed.
Yeah, it's basically the hangover effect of an exceptionally good year.
Right. But the second headwind they pointed to was a bit more macroeconomic. They noted softer consumer demand during the time frame of the U.S. government shutdown.
Yeah, and look, that might sound like a convenient excuse.
It kind of does.
But the mechanics of grocery spending during periods of extreme headline uncertainty are very real. When consumer confidence drops, basket sizes shrink.
So people skip the premium produce dip and just, buy the raw vegetables?
Exactly. The psychology shifts from discretionary indulgence to pure utility. You just buy what you need.
Okay, that makes sense. But even with that 1.1% dip in retail, you really have to look at the market share they command. Because in certain subcategories, it borders on monopolistic.
Oh, it's wild. Their New York Bakery frozen garlic bread brand currently holds a 44.6% market share.
They control nearly half of the entire frozen garlic bread market in the United States.
Almost half. And it gets even more concentrated than that. The Marzetti brand produce dips, the caramel apple dips or the veggie ranch dips in the produce section.
Yeah, I love those.
Right. Well, they command a 75.5% market share.
75.5%. They effectively own the entire category.
They do. When a retailer like Kroger or Safeway is designing their produce section, Marzetti isn't just one of the options. Marzetti is the anchor tenant that dictates the layout of the shelf.
Wow. That kind of market dominance gives them immense leverage for negotiating slotting fees and things like that.
Absolutely.
But retail is only half the equation here. The food service segment, where they supply sauces and dressings in bulk to restaurant chains, that was reported as essentially flat for the quarter.
Right, but flat is a very deceptive word here.
How so?
Because it implies stagnation. But the underlying current of their food service division is incredibly robust. I mean, they are acting as the hidden supply chain infrastructure for some of the largest quick service restaurants on the planet.
Like who?
Well, management specifically name-dropped Chipotle, Domino's, and Taco Bell as massive national accounts they are currently servicing.
Oh, wow. So when you are eating a pizza or a burrito or a taco from these mega brands, there is a highly probable chance you are consuming a sauce manufactured in a Marzetti facility.
Yep. And the strategic value of those accounts cannot be overstated. When you secure a contract with Domino's, you are locking in massive, predictable volume.
So why was it flat then?
CEO Dave Senske pointed out that the flat growth this quarter was mostly due to lapping a few LTO's limited time offerings from the previous year.
Ah, okay. So those temporary menu items cause massive short-term spikes in demand, and once the promotion ends, the volume just normalizes.
Exactly. But beneath that normalization, the core recurring volume with these national chains is rock solid.
Okay, so pulling back, we have a company with absolute dominance in specific grocery aisles, a deeply embedded commercial food service business, and the pricing power to protect margins.
Right. It's highly efficient, incredibly profitable.
That's fundamentally a low-growth machine.
Yes.
And I think that is exactly why the announcement they made during this earnings call was so disruptive. Like, this wasn't just a tweak to the dividend.
No, not at all.
They announced a definitive agreement to acquire Backens for $400 million in cash.
$400 million in straight cash for a Japanese-American barbecue sauce brand.
It's wild.
It is the pivot point for the entire future of the Marzetti Company, because Bakkens is not a legacy staple. It's a premium, authentically positioned, multi-generational family recipe built by its founder, Justin Gill.
Right, and it has just completely hijacked the sauce category lately. I see it everywhere. It's driven by massive viral adoption on social media, plus aggressive retail placement in stores like Costco.
Yeah, if you walk down a sauce aisle today, Bakkens immediately jumps out. It has that distinct squeeze bottle, the octopus logo.
Yeah, it completely breaks the traditional mold of those heavy glass BBQ sauce bottles that haven't changed in like 30 years.
Exactly. It is aggressively targeting a younger demographic, millennials and Gen Z.
But still, $400 million is a breathtaking valuation for a sauce. I mean, how did management justify that?
Well, they justified it by heavily leaning into the financial metrics of the brand. Specifically, they noted that Bakkens is margin accretive to Marzetti's overall portfolio.
Okay, let's translate that Wall Street jargon into plain English. What does margin accretive actually mean for this deal?
Sure. Margin accretive basically means that the profit margin on a single bottle of Bakkens is mathematically higher than the average profit margin across Marzetti's existing products.
Because Bakkens commands a premium price point, right? Like, consumers are willing to pay $7 or $8 for a bottle.
Exactly. So the spread between the cost to make it and the retail price is very wide. The very second Marzetti closes this deal and integrates Bakkens' revenue onto their income statement, Marzetti's overall corporate profit margin immediately goes up.
Okay, so it structurally improves their profitability from day one.
Yes. But the real upside comes from how Bakkens is actually manufactured today.
Right.
Currently, Bakkens is entirely co-packed.
Which means what exactly? Like, what's the difference there?
Think of it as a difference between renting an apartment and owning a house. Right now, Bakkens owns the recipe and the brand, but they are renting the factory. They pay third-party manufacturing facilities, the co-packers, to mix, bottle, and ship the sauce.
Got it. Which is an incredibly common strategy for fast-growing food startups, right?
Yeah.
Because it requires zero capital expenditure up front. You don't have to build a $100 million factory just to launch your sauce.
Exactly. But the trade-off is that the co-packer takes a massive cut of your profit margin. They have to make money too, which puts a ceiling on how profitable the brand can actually be.
And this is where Marzetti's legacy infrastructure becomes the ultimate unlock.
You see where this is going?
Because Marzetti is a manufacturing leviathan. Over the next few years, they can pull Bacans out of those expensive co-packing agreements and bring the production entirely in-house.
Yes, they are moving from renting to owning. And when you eliminate that third-party manufacturing markup, the cost to produce every single bottle of Bacans plummets.
Wow. So the margin expansion potential there is astronomical.
It really is. Marzetti isn't just buying a brand. They're buying a highly inefficient manufacturing model that they possess the exact tools to fix.
And they are applying those tools to a brand growing at an insane velocity.
Right. Management revealed that between 2022 and 2025, Bacans compounded its growth at an annualized rate of 48%.
A 48% compound annual growth rate over 3 years. I mean, in the consumer packaged goods sector, eking out 2 or 3% growth is a massive victory. 48% is hyperspeed.
It completely alters the growth trajectory of Marzetti's top line.
But wait, deploying $400 million in cash, that requires an equal measure of operational ruthlessness on the other side of the ledger, doesn't it? You can't fund hypergrowth while carrying dead weight.
No, you definitely can't. And the CFO, Tom Pigott, made it very clear that they are actively cutting away the necrotic tissue of their older business lines.
What did they cut?
Well, they announced a $1.7 million restructuring and impairment charge in this quarter alone.
Okay, so for the listener, an impairment charge is essentially an accounting reality check. It's a non-cash hit where the company admits that a physical asset, like old factory equipment, is no longer mathematically capable of generating the value they originally expected.
Exactly. They are writing down the value of old, inefficient machinery to clear the decks.
Yep.
And that accounting maneuver was paired with hard physical action.
Oh!
Yeah, they announced the planned closure of an entire sauce and dressing facility located in Lopi, Texas.
Shutting down a whole facility, that is a massive, complex operational undertaking.
It's brutal. You have to sever employee contracts, reroute logistics, decommission heavy machinery.
Yeah.
But it is a necessary surgical amputation.
Right. They shed an older, lower margin facility, take the accounting hit, and pivot all that capital toward optimizing the Bacans integration.
Exactly.
But let me play devil's advocate here. The juxtaposition is fascinating, right? You have this entrenched, defensive, 63-year-old dividend company essentially executing a massive venture capital play.
Yeah.
Isn't this just a corporate midlife crisis? Like, is Marzetti acting like the 50-year-old guy who buys a red sports car because he wants to look cool? Because legacy brands buying trendy startups often ends in disaster. The bureaucracy just crushes the startup's culture.
I mean, the corporate midlife crisis is a real phenomenon in M&A, but the Q&A portion of this earnings call dismantled that theory thoroughly.
Really? Oh.
This is not a vanity purchase. It's a highly engineered, deeply calculated bolt-on acquisition that drops perfectly into an infrastructure. Marzetti has spent the last half-decade rebuilding.
Rebuilding? What have they been doing?
Well, Dave Sinsko was adamant about this when fielding questions. Marzetti has not been sitting still. They recently completely tore out their legacy IT architecture,
Okay.
a system that had been running the company since 1994.
Wait, 1994, they were running a multi-$100 million supply chain on software built during the era of dial-up internet.
Yes, and running modern logistics on 1994 software creates massive friction. Blind spots in inventory, terrible forecasting, agonizingly slow response times.
I can't even imagine.
So they ripped all of that out and successfully implemented a state-of-the-art cloud-based ERP system. They aggressively modernized their physical manufacturing lines.
Wow.
And most importantly, they ruthlessly narrowed their entire corporate identity down to 3 specific core competencies: sauces, dressings, and dips.
Which means Bacans isn't some random shiny object outside of their expertise. It is the exact profile of product they are engineered to manufacture.
Exactly. They can drop Bacans directly into this newly modernized supply chain and immediately scale it.
Plus, they possess the established grocery distribution networks to take Bacans from, like, a regional club store presence and force multiply it internationally. I saw they were eyeing expansion into Canada.
Yeah, and think about the cross-pollination potential within their food service division. Marzetti already holds the vendor relationships with giants like Domino's and Taco Bell.
Oh, wow. So they could walk into a boardroom and pitch a limited-time Backens-infused menu item.
Exactly. The startup gets national quick service scale, and the restaurant gets the halo effect of a viral Gen Z brand. Marzetti operates as the toll bridge connecting the two.
It's a textbook synergistic M&A, assuming the execution matches the blueprint.
Right.
So with this massive strategic pivot underway, what does management actually expect the rest of the year to look like? Let's dissect their forward guidance.
Sure. So management's projection for the core legacy business is incredibly grounded. They are forecasting low single-digit volume growth.
Makes sense. They aren't pretending salad dressing is suddenly going to experience a renaissance.
No, that low single-digit growth is just the bedrock. But outside of that, their internal licensing strategy is exhibiting explosive momentum.
Oh, we have to talk about the Texas Roadhouse dinner rolls.
Yes, we do.
Because if you've ever eaten at a Texas Roadhouse, you know the fresh-baked rolls with the cinnamon honey butter are the most iconic part of the experience. And Marzetti brilliantly secured the licensing rights to sell those exact rolls in the frozen aisle.
It's a genius strategy. They are essentially renting the massive pre-existing brand equity of Texas Roadhouse.
And it is converting at a phenomenal rate.
Phenomenal. During the call, management revealed that this specific licensed product line is rapidly approaching a $100 million retail run rate.
Generating a $100 million run rate off a single licensed side item, that's staggering.
They generated over $20 million in sales from these rolls in Q2 alone.
Wow. And they noted they are still expanding the retail distribution, meaning there is still white space for this product to grow.
Yep. They are even in active negotiations to expand the licensing agreement to include new flavor profiles.
So this has evolved from a clever novelty item into a structural pillar of their revenue.
Exactly. But the guidance for the food service side requires a deeper look into the macro environment. Management is forecasting flat to modest improvement in food service volume.
Okay, but the rationale Dave Sensky provided for this forecast was wild to me.
The gas prices.
Yes. He didn't point to aggressive sales initiatives. He pointed directly to macroeconomic tailwinds, like the recent drop in global gas prices and the timing of income tax returns. I mean, relying on external factors like gas prices, isn't that like hoping for good weather to make a sale?
At first glance, it feels like a massive stretch. It feels like an admission that you have zero control over your own destiny.
Exactly.
But the economic causality here is actually deeply entrenched in consumer behavior. Cheaper gas directly injects discretionary liquidity into the middle-class consumer.
It functions as an immediate, unlegislated tax cut.
Right. If the average family is spending $20 or $30 less to fill up every week, that capital doesn't disappear into a savings account. It gets reallocated instantly into discretionary spending.
And the primary beneficiary of that is the quick service restaurant industry. That $20 saved becomes a Friday night trip to Chipotle.
Which means Marzetti gets a spike in bulk sauce orders. The same psychological mechanism applies to income tax returns. Senska noted they anticipate stronger tax refunds hitting right around President's Day weekend, which triggers a boom in away-from-home dining.
Okay, I get the logic. But relying on macro tailwinds is inherently dangerous. If crude oil spikes, that tailwind instantly becomes a brutal headwind. If you build your growth thesis on cheap gas, you are building a house on sand.
True, which is why the balance of their portfolio is so critical. The macro factors are just the weather. The internal licensing deals and the Bakkens integration are the actual engines driving the ship.
Right. They'll take the free speed from the macro tailwinds, but they aren't entirely reliant on them.
Exactly. And we know they are focused on building a better engine because of their capital expenditure forecast.
Oh.
The CFO laid out a CapEx budget for fiscal year 2026 between $75 and $85 million.
So they aren't just hoarding cash, they are actively deploying it.
Earmarked for advanced cost savings projects and upgrading a facility in Atlanta. They are hardening their supply chain against future shocks.
Okay, so we've dissected the margins, the pricing power, the Bakkens acquisition, the macro guidance. It's time to synthesize this into a definitive verdict.
Let's do it.
Based on everything we've talked about, are we looking at a bullish or bearish signal for Marzetti?
When you strip away the noise, this is a decidedly aggressively bullish signal.
I agree. The bull case here is built entirely on financial discipline, granting them the luxury of strategic aggression. They entered this quarter with a fortress balance sheet, zero debt.
Zero debt in this economic environment is an undeniable superpower. plus $201 million in raw cash.
Which let them execute a $400 million acquisition without destabilizing operations.
Right. It's the exact playbook you want from a mature company. Defending the 63-year dividend streak while buying into high-growth segments.
Playing ironclad defense with the balance sheet and absolute hyper-growth offense with Bockins.
Yep.
So actionable intelligence for the listener. If you currently hold MZTI, this call is massive validation. Your dividend is insulated, and you basically got a free call option on a massive Gen Z growth engine.
And if you are looking to deploy fresh capital, Marzetti offers a rare hybrid asset, the defensive floor of a 63-year staple, with the asymmetric upside of a brand growing at a 48% CAGR.
The tortoise didn't just strap a rocket to its shell, it bought the rocket factory. But this Backins acquisition reveals a much larger shift in the food industry.
Absolutely.
Look at Justin Gill, the founder of Backins. He took on immense risk, spent years iterating the recipe, fighting for shelf space, hustling for Costco trials.
He absorbed 100% of the early-stage entrepreneurial friction.
While Marzetti just sat back in their zero-debt fortress, accumulating cash from boring legacy brands, they let independent founders fight it out in a brutal startup environment and then just swooped in to buy the winner.
It is the ultimate luxury of capitalized patience. They outsourced the innovation phase entirely.
Exactly. Which leaves you wondering, is this the future of the legacy food sector? Are conglomerates just abandoning internal R&D to become giant venture capital funds for TikTok famous items?
It's a fundamental paradigm shift. Innovation isn't happening in corporate labs anymore. It's happening in independent kitchens. And the legacy corporations are just waiting at the finish line with a checkbook.
It completely changes how you should view every viral brand you see online. The question isn't if they can survive, but which legacy conglomerate is waiting to write them a $400 million check.
Well said.
Thank you for joining us on this deep dive into Marzetti's Q2 earnings. We hope we expose the mechanics driving this 63-year-old dividend machine's evolution.
Always look past the headline numbers. Look for structural efficiencies, track the capital allocation, and stay curious about the supply chain.
Until next time, keep your portfolio sharp, demand more from your dividend stocks, and remember, even the sleepiest companies can wake up and completely rewrite their DNA.